Deep beneath the rolling hills of Kentucky, nestled within the heavily fortified walls of Fort Knox, lies a treasure trove of unimaginable value. At least, that's what we've been told. The US government claims to hold a staggering 8,133.5 metric tons of gold, a shimmering monument to American economic might. But what if it's not actually there? What if the vaults, long shrouded in secrecy, are actually empty? It sounds like the plot of a cheesy heist movie, but the lack of transparency surrounding the US gold reserves has fueled conspiracy theories for decades. Some whisper that the gold was secretly leased or sold off, perhaps to covertly fund covert operations or bail out failing banks. Others believe it was pilfered long ago, replaced with worthless fakes in a cunning act of grand larceny. Fueling the paranoia are the infrequent and tightly controlled audits. These audits, shrouded in secrecy, do little to quell the doubts. The last time the public was granted a glimpse inside Fort Knox was in 1974, when a group of politicians and journalists were led on a carefully orchestrated tour. Was it a genuine display of transparency, or a carefully staged performance designed to maintain a facade? The truth, as they say, is out there. But in a world increasingly defined by digital uncertainties, one thing is becoming abundantly clear: the age-old allure of gold might be losing its shine. Gold. The very word evokes images of opulence, power, and enduring value. For millennia, this lustrous metal has captivated civilizations, fueling wars, shaping destinies, and serving as the bedrock of global finance. From the pharaohs of Egypt to the Roman Empire, gold has been the ultimate symbol of wealth and stability. Its scarcity, coupled with its inherent beauty and resistance to corrosion, made it the ideal medium of exchange. Nations pegged their currencies to it. Empires rose and fell on its acquisition, and individuals sought solace in its tangible, enduring value. But the world is changing. The digital revolution, with its disruptive technologies and paradigm-shifting innovations, is challenging the established order. The rise of cryptocurrencies, particularly Bitcoin, has thrown a proverbial wrench into the machinery of traditional finance, raising questions about the future of money itself. Is gold, once considered the ultimate safe haven asset, still relevant in a world increasingly driven by digital currencies and decentralized systems? Or is it destined to become a relic of a bygone era, a nostalgic reminder of a time when wealth was measured in bars and coins rather than bits and bytes? In the vast and often volatile landscape of the digital world, a new kind of asset has emerged, one that operates outside the control of governments and financial institutions. Its name is Bitcoin, and it's shaking the very foundations of the global financial system. Bitcoin is a cryptocurrency, a form of digital money that utilizes cryptography for security and operates on a decentralized network called a blockchain. This blockchain, a public ledger of all transactions, ensures transparency and immutability, making it virtually impossible to counterfeit or double-spend Bitcoin. Unlike traditional currencies, which are subject to inflation and manipulation by central banks, Bitcoin has a fixed supply. There will only ever be 21 million Bitcoins in existence, a fact hard-coded into its underlying protocol. This scarcity, combined with its decentralized nature and growing acceptance as a legitimate asset class, has led many to believe that Bitcoin could be the new gold. But how does this digital upstart actually stack up against the venerable precious metal that has captivated civilizations for centuries? Let's delve into the ultimate showdown: gold versus Bitcoin. On the surface, gold and Bitcoin might seem like unlikely contenders in the battle for financial supremacy. One is a physical asset, coveted for its beauty and intrinsic value for millennia. The other is a purely digital construct, a string of codes existing solely in the ethereal realm of cyberspace. Gold is heavy, tangible, and reassuringly familiar. Its value, while subject to market fluctuations, is underpinned by its historical significance, industrial applications, and sheer scarcity. Bitcoin, on the other hand, is intangible, volatile, and often perplexing to those unfamiliar with the intricacies of blockchain technology. Its value is derived solely from market demand and the belief in its underlying technology. However, beneath the surface, these two assets share some striking similarities. Both are scarce, divisible, portable, and resistant to censorship. Gold's scarcity is inherent, limited by the geological constraints of our planet. Bitcoin's scarcity is artificial. enforced by the mathematical principles governing its creation. Gold can be melted down and recast, divided into smaller units or combined to form larger ones. Bitcoin can be traded in fractions of a coin, making it accessible to investors of all sizes. As the debate between gold and Bitcoin rages on, experts and analysts are weighing in, offering their perspectives on the future of these two assets and their potential impact on the global financial system. One such expert is Marion Laboure, a renowned economist at Deutsche Bank, whose insights into the evolving landscape of finance have garnered attention worldwide. Laboure, dubbed the Oracle of Bitcoin by some, has been vocal in her belief that Bitcoin is more than just a speculative asset. She sees it as a paradigm shift in the way we think about money, a potential challenger to the established order of central banks and fiat currencies. Bitcoin is the 21st century gold, Laboure famously proclaimed, arguing that its digital nature, fixed supply, and borderless transactions make it an ideal store of value in an increasingly uncertain world. She points to the inherent flaws in the current financial system, such as inflation, currency manipulation, and the erosion of purchasing power, as reasons why Bitcoin's appeal is growing, particularly among younger generations who are digitally native and distrustful of traditional institutions. The rise of Bitcoin and other cryptocurrencies presents a unique challenge to sovereign wealth funds, the behemoth investment vehicles used by governments to manage their national reserves. For decades, these funds have relied on a diversified portfolio of assets, with a heavy emphasis on gold, government bonds, and other traditional investments. But the emergence of Bitcoin as a potential safe haven asset has thrown a wrench into their carefully crafted investment strategies. Should these guardians of national wealth, tasked with preserving and growing their nation's wealth for generations to come, embrace this new digital frontier? Or should they stick to the tried and true, viewing Bitcoin as too volatile and risky for their conservative mandates? The dilemma is further complicated by the decentralized nature of Bitcoin. Unlike traditional assets which exist within the established framework of global finance, Bitcoin operates outside the control of governments and central banks. This lack of control is both alluring and unsettling for sovereign wealth funds, accustomed to wielding significant influence in the financial world. As the digital revolution continues to reshape the world around us, the future of finance remains shrouded in uncertainty. Will Bitcoin, the enigmatic cryptocurrency that has captured the imagination of investors and technologists alike, fulfill its promise as the new gold, ushering in a new era of decentralized finance? Or will it fade into obscurity, another casualty in the ever-evolving landscape of technological innovation? The answer, like the future itself, remains unwritten. However, one thing is certain: the emergence of Bitcoin has irrevocably altered the financial landscape, challenging the established order and forcing us to rethink the very nature of money and value. As we stand at the cusp of this digital frontier, one can't help but wonder, is this the dawn of a new world order? One in which the power of money is no longer concentrated in the hands of the few, but distributed amongst the many? Only time will tell. But one thing is certain: the future of finance is digital, decentralized, and ripe with possibilities.